Let me show you what I mean by positive and negative delta here. On the calls you have delta. Delta is the rate at which the option will move for every $1 move in the underlying stock. Delta is higher when the option is in the money. For example, let's take this. You can see as you go up here, the further the options are in the money, the higher their delta. What does that mean? Well, let's say the price of the SPYs goes up $1, and we had one of the 133 strike calls. This call is expected to increase in price if the SPYs move up by $1. You take the 0.73 delta, multiply it by the dollar move, and you get a 73-cent increase in the price of that option. That's how that option will move. It will increase by 73 cents. The closer you get to at the money options, the lesser the delta. So many people purchase these at the money calls, and the delta of the at the money call is only 49 cents. So in other words, if the SPYs move up $1, this option will only increase by 50 cents. There is not a dollar for dollar increase in the price of that option as the SPYs move up. The farther you get into the money, you can see that if you purchased an extremely deep in the money option, the delta is 95. Actually, if the price of SPY goes up by $1, this option will increase by 95 cents. Almost perfect one-to-one ratio on the move in the underlying of this option. So when you purchase an option that has a high delta, 55, and you sell, for example, on this one right here, if we were to buy a vertical spread, and we bought this option that had a delta 55, and we sold this option that had a 49, all you have to do is subtract these two. The 55 minus the 49 is 6. You would have a positive delta of 0.06 or 6 cents. Let's try it. We're going to buy a vertical spread, and then we're going to analyze it. Let's just get rid of this for a second. And you can see that the delta is a positive 6. It's almost approximately $6. And the theta is negative. Let's go back again, and this time let's sell it. We're going to sell a vertical spread. Now what we're doing is we're selling a call with a higher delta than the one that we're buying. So now we should be very close to a negative $6 in delta and a positive theta. And that's exactly what we have. We have a negative delta and a positive theta. Okay, so what we want to do now, and that's why primarily we tend to sell options rather than buy them. And we sell them for more than we buy them for. That's like what every good business does. As I was saying, we don't want to purchase an iron condor. We want to actually sell an iron condor. In some cases, it does make sense to buy iron condors if you think a very large move in the market is coming. However, in our case, in most cases, we tend to sell iron condors. We're going to be selling the 141 and buying the 142. Why? Well, let's take a look at the deltas for a second. Actually, I'd rather sell this one with a 25 delta. So we're going to go up to the 142, and we're going to sell the 143. I'm sorry, we're going to buy the 143. And on the put side, because it brought up this automatically, on the put side, we're going to go down to a delta of minus 24. Puts always have a negative delta. Calls always have a positive delta. So we're going to sell right around the 24 strike delta, which is the 132 strike. And we're going to buy the 131 as protection. Remember, we don't want to sell naked options.